why does an accounting standard care about who is on the trading floor? I mean, when we think of strict financial reporting, we usually picture balance sheets, cash flows, profit margins, right? Human resources doesn't exactly spring to mind. But what if I told you that the actual demographic makeup of a firm's workforce is now being treated as a critical, hard financial metric? Let's figure out why. Okay, let's dive into this. Welcome to this explainer where we're going to unpack Wall Street's new diversity standard. We're going to see exactly why diversity and inclusion are absolutely no longer just corporate buzzwords or, a PR exercise. They are now a measurable financial imperative for investment banks and brokerages. Here's our step-by-step roadmap to solving that opening question. First, we'll look at the new Wall Street standard. Second, the war for skilled talent. Third, diversity as risk management. Fourth, measuring the metrics. And finally, we'll bring it all together with the bottom line. Let's get started. All right, let's jump straight into Section 1, the new Wall Street Standard. So what we're looking at here is the 2023-12 version of the SASB Sustainability Accounting Standard for Investment Banking and Brokerage. Now, this is currently under the stewardship of the International Sustainability Standards Board, or ISSB for short. And let me be clear, these are not just some arbitrary feel-good guidelines. This is a globally recognized framework built to identify risks that actually affect a company's prospects. And right at its core, a strict focus on employee diversity and inclusion. The crucial point here is that these standards exist for one main reason: to track risks and opportunities that directly affect cash flows and the cost of capital over the short, medium, and long term. This standard doesn't look at diversity as a mere social initiative. It treats it as a hard financial variable. Basically, the way a bank manages its human capital literally impacts its financial stability and overall performance. Which brings us to Section 2, the war for skilled talent. Think back to Wall Street a few decades ago. You probably picture traders just yelling over each other on a crazy, crowded floor, right? Well, today, those loud trading pits have mostly been replaced by silent server rooms. Modern trading is defined by incredibly complex financial products, computerized algorithms, and high-frequency trading. Because of this massive technological shift, the skills you actually need to be profitable have completely changed. It sparked an absolute war for highly specialized talent. And this highlights a huge financial argument made by the standard. By actively ensuring gender and racial diversity, banks dramatically expand their candidate pool. If you limit your hiring based on, say, outdated demographic norms, you're just artificially shrinking your talent pipeline in a hyper-competitive market. The standard points out that actively widening this pool reduces hiring costs, improves operational efficiency, and helps you grab that specialized talent. So actively seeking diverse talent is a direct, quantifiable advantage. Moving right along to our third section, and arguably the most dramatic part of this explainer: diversity as risk management. Listen to this exact quote from the SASB topic summary. Evidence also suggests that entities with more diverse groups of employees may reduce risk-taking among employees involved in risk-prone trading activities. I want you to stop and really think about that for a second. An accounting standard is formally recognizing that the actual demographic makeup of a trading floor literally affects a firm's risk profile. This brilliantly illustrates our main point. It's incredible, really. Diversity is being treated as a literal hedge against excessive financial risk. Think about it. When you have a totally homogenous group of people with the exact same backgrounds, maybe all wearing the exact same fleece vests, you risk dangerous groupthink. People might just blindly agree on aggressive, risky trades without any critical pushback. But introducing diverse perspectives, the evidence suggests you naturally mitigate those risk-prone behaviors, which directly protects the firm's bottom line and, honestly, the broader financial system. All right, Section 4, measuring the metrics. Let's see how they actually force banks to report this data transparently. Now, what's really interesting about this slide is how strict the categorization is. Banks are absolutely not allowed to just provide one blended, company-wide number to make themselves look good. No way. They are structurally forced to break down their diversity percentages across 4 very distinct levels: executive management, non-executive management, highly skilled professionals, and all other employees. They literally have to prove that diversity exists at the highest executive decision-making levels, not just at the entry level. Take a look at this. This is an actual blank reporting table straight from the standard, Table 3, focused on gender. It forces banks to cross-reference those 4 employee categories against gender, specifically women, men, or not disclosed. Structurally, it forces total transparency. An investor can look at this exact grid and instantly know if a firm has equitable representation all the way up the corporate ladder, or if all their diverse talent is just bottlenecked at the bottom. But wait, it doesn't stop at gender. Here is Table 4, which tracks broader diversity group representation. The standard defines these groups widely, encompassing things like race, ethnicity, age, disability status, migrant status, or even socioeconomic background. And again, the banks have to apply the exact same rigorous corporate breakdowns we just talked about. It's a granular, highly structured way of quantifying human capital. And that brings us to our final section. Section 5, the bottom line. Let's bring all these financial and structural threads together to summarize the core thesis of this SASB standard. Basically, diversity and inclusion are a quantifiable, multi-pronged financial strategy. Number 1, it allows banks to attract skilled labor by maximizing their candidate pool and lowering hiring costs. Number 2, a robust talent pool is absolutely vital to adapt to rapid tech advancements like algorithmic trading. And number 3, it serves as a critical safeguard against excessive, risk-prone trading behavior, literally protecting the firm's assets. So we end right back where we started. Who is on the trading floor absolutely matters to the bottom line. And it leaves us with a pretty fascinating question to chew on. If an accounting standard now recognizes diversity as a quantifiable hedge against financial risk, what other supposedly social metrics are Wall Street's pricing models and algorithms completely missing? Thanks for joining me for this explainer, and definitely keep questioning how we define true value in the modern market.